The taxation of rental income in Canada can often be complex and confusing for property owners, especially if you're new to the world of real estate investing. As a property owner in Canada, it's crucial to understand how the tax system works for rental income, the deductions and credits you may be eligible for, and what you need to report on your tax return. I will provide a comprehensive guide on how the Canadian tax system treats rental income and what you need to know to handle your taxes with confidence. In Canada, rental income is considered as income from property, and it must be reported on your personal income tax return, T1 return, irrespective of whether you are a resident or a non-resident of Canada. Any rental income you receive must be reported on Form T776, Statement of Real Estate Rentals, to calculate the net income or loss from your rental property. Once you have determined your net rental income, this amount will be added to your other sources of income and taxed at your marginal tax rate. One of the key aspects of calculating your net rental income is understanding what deductions and expenses you can claim against your rental income. These deductions help to reduce your taxable rental income, resulting in lower taxes. Some of the common deductions that you can claim include mortgage interest, not the principal amount, property taxes, insurance premiums, property management fees, maintenance and repair costs, utilities, if paid by the property owner, depreciation, capital cost allowance, advertising and promotion expenses, professional fees, lawyer, accountant, etc. It is essential to keep accurate records of all your rental income and expenses, since the Canada Revenue Agency, CRA, may request to see your documents if your return is reviewed. When you sell your rental property, you may either have a capital gain or a capital loss, depending on the selling price and your adjusted cost base, ACB, of the property. The ACB includes the purchase price of the property, any additions or improvements made to the property, and any related expenses, such as legal fees, land transfer taxes, and commission fees. In case of a capital gain, you must report 50% of the gain as taxable income. On the other hand, if you have a capital loss, you can use it to offset any capital gains you have in the current tax year, or carry it back up to 3 years, or carry it forward indefinitely to offset future capital gains. If you are a non-resident property owner in Canada, you will be subject to a 25% withholding tax on your gross rental income. This tax must be remitted to the CRA by your Canadian property management company or tenant on your behalf. However, you can reduce this withholding tax by filing a Section 216 tax return, where you report your net rental income and pay taxes on this amount. Once you have filed a Section 216 tax return and paid the tax owing, the CRA will issue a notice of assessment, which you can provide to your tenant or property management company as proof that your tax obligations have been met. Given the complexity of taxation for rental income in Canada, it is highly recommended to consult with a tax professional or a financial advisor who has experience in real estate taxation. This expert guidance can help you understand your tax obligations, maximize your deductions, and ensure that you are compliant with the CRA reporting requirements. A tax professional can also provide valuable advice on optimizing your tax planning for your rental properties and suggesting tax-efficient strategies to grow your real estate portfolio.